You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it is time once again for TWIFO, This Week in Futures Options, the program where the name pretty much says it all. We break down the week that was and indeed still is out there in the futures options markets. What's going to make it onto the show? You got to tune in every week to find out. Will it be corn? Will it be Bitcoin? Will it be nat gas, gold, platinum, lean hogs, live cattle? You never know what's going to make it onto the show each week. My name, of course, Mark Longo from theoptionsinsider.com, as well as, of course, from the ever compelling, ever fascinating Options Insider Radio Network. Reminding you, of course, if you like what you hear on the on-demand side, then, of course, keep rating and reviewing. More important than ever, you can argue, in the 15-plus year history of the network, because so many new folks are discovering it, and they're turning to outlets like your Apple Podcasts or Google or Spotify, whatever the case may be, and looking for cool new options content. And lo and behold, there we are. And your ratings and reviews will go a long way towards helping those folks pull the trigger and give it a download, give it a subscribe, give it a listen. Of course, if you want even more in your life than what's hitting you twice a day on the network, then you can go to theoptionsinsider.com/pro. That gets you, of course, exclusive pro Q&A sessions where you can ask questions from some of the best minds in the world of options and derivatives. Whatever's on your top of your brain, you can hit them up with it. They're pretty fun. And, of course, unusual activity every Friday. Some fun stuff on the docket for this week. We'll get into it on Options Oddities coming up. Of course, live access to this and everything else we do throughout the week. Great giveaways, which is causing no end of consternation amongst all my other co-hosts. They all want the cool stuff you guys are getting, but we say no. It's only for our pro members. Where can you go get access to all that cool stuff? theoptionsinsider.com/pro. Or for you cool kids, /secret club. Let's see who's joining us out there today in the CME Group and FTSE Russell hot seat. I am pleased to welcome back our old friend, Miss Carley Garner, the senior analyst and broker over there at DeCarley Trading, as well as the author of one or two or half a dozen futures options tomes. Carley, welcome back to TWIFO, madam.
Thanks, Mark. I'm looking forward to it.
All right, then let us commence the business. Let's dive right into the movers and shakers report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everybody, welcome to the Movers and Shakers Report, the portion of the show where we break down everything lighting it up to the light side, a.k.a. the upside, and to the dark side out there at CME Group this week. If you want to see this report for yourselves right before showtime, if you follow CME or if you follow us on Twitter, you'll see it there. It's been so much stuff. It's been hard to read. We've endeavored. I think we've made it a little bit easier for you folks to see the lines of demarcation now. Don't blame us. The report's just so jam-packed with stuff. Sometimes it's hard to see everything. So we're working to make it even easier for you folks over there. At Options is the place to find that before showtime at CME Group as well. All right, Carley, you know what time it is. Where should we begin our journey, to the light side or to the dark side this week?
Well, Mark, in a world full of darkness, let's go to the light side.
There we go. Spoken like a true light side fangirl that you are out there. All right, to the light side we go. We've actually got a bit of a tie. By the way, before we even get there, it is a dark side biased week, but I say that with a slight hesitancy because the most extreme mover we have is to the dark side. And there are more dark side than light side, but only slightly. And it's not like the upside is not doing a lot of business this week as well, but it's an intriguing one nonetheless. Certainly a lot more evenly split than we've seen recently, where we can only do a top or bottom three in a given week or four. Certainly don't have that problem this week. So to the light side we go, even though the number 5/4 spot, we have a tie. It's a tie between live cattle and then, of course, the product they produce, which is Class 3 milk. Both of them up 2.5% this week here on the show. We haven't really talked cattle before. Class 3 milk starting to come into its own a little bit more, so it's possible to hang our hats out there. Number 3, out to the beans, soybean oil in particular this week, up 6.01%. We've seen all different facets of the soybean complex really lighting it up over the past few weeks, and now it's soybean oil's turn, again, up 6.01%. Number 2, it's lumber, up 7.06%, one of our 3 frequent offenders. You guess one of these 3 any given week, listeners, you have a pretty good chance of being right. And lumber certainly gets the award for the most active underlying contract without any real options paper. That might be changing. We'll chat about that with Carley in a little bit. It was number 1 in the same direction last week, up 6.22%. So pretty explosive couple of weeks to the upside here for lumber, listeners. Again, before you get too excited, 60-odd contracts on the tape. Again, that's a lot more than lumber used to do. So that's a sign it's moving in the right direction, but still not a lot to sink our teeth into. And number 1, with a pretty strong 7.82%, is our old friend Lean Hogs. It was number 4 in the same direction last week, up 4%. So a pretty strong couple of weeks here for Lean Hogs. And again, usually north of 20,000+ contracts these days. So we can definitely sink our teeth into Lean Hogs potentially again this week. Now to the dark side we go. Number 5, the Ultra 30-year off 3.53%. Number 4, we've got SRW wheat, so Chicago wheat, off 4.85%. Number 3, moving away from rates and away from ags to energy, we've got heating oil off 5.3%. It was number 2 in the other direction last week, up 4.33%. So losing more than it gained last week. And again, it does some paper, but it's only about 3,000 contracts. So not a ton for us to analyze out there in heating oil. Number 2, it's oats off 7.98%. It was number 5 in the other direction last week, up 3.21%. And again, before you get all hot and bothered about oats, 10 contracts on the tape. So I wish we could play with oats, but alas, no. And then the number 1 dark side mover, the biggest mover at CME this week, nat gas off 14.42%. Man, they have come for nat gas this week. That's a pretty aggressive move. Carley, I know you love playing a little bit in nat gas as well, so I think we'll start in the energy first.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, everybody, welcome to the energy section of the show. You guys know where to go to find these reports. CMEgroup.com/TWIFO, TWIFO. Once you're there, go into that drop down and then scroll down 3 asset classes to energy. Then we're going to go over into the product family. Again, scroll down 3 to nat gas and pick that top selection. And you will have the nat gas report in your hot little hands. Carley, I remember the last time you and I chatted, you were looking at some key support and resistant levels out here in nat gas. It seems like we've blown through that support since the last time you and I chatted. What are your thoughts on this pretty aggressive downside move we're seeing in nat gas this week, Carley?
Yeah, we've absolutely broken a couple of levels here. The next level I'm looking at, it's about 550 in the December contract. So, I mean, we're talking maybe another 10, 15 cents from today's lows, and we should find some really good footing. I mean, there's a lot of fundamental things going on. We're having trouble getting liquefied natural gas out. We're in the UK, they're no longer talking about banning fracking. So there's some stories that kind of the rug was pulled out and the market sold off. And we're starting to get to a point where if you look at the COT report, there's more people short natural gas than we've seen, I think since March 2020 or somewhere in that ballpark. So don't quote me on that, but it's the shortest the market's been for a very long time. And usually when you start seeing that sort of thing, big short squeezes are possible. So maybe we've got a little further to go on the downside. But I think we're getting closer to a bottom than most people are maybe assuming. And unfortunately, I think we're also getting some margin call selling. And so you know how that goes. People are selling because they have to, not because they want to. So if you're lucky enough to be on the sidelines of natural gas and you happen to have a lot of margin available and you have nerves of steel and you're willing to take the risk of a wild market like this, now is probably a pretty good time to put on some option spreads, maybe buy some call spreads and sell a deep out of the money put to pay for it. That sort of thing probably looks attractive here. If you already have a foot in the door, you're probably playing defense instead of offense. And the good news is most of the pain is probably behind us. It might get better here in the next week or so.
Yeah, right. How long have we been talking about, 10 strikes and 12 strikes and 15? And everyone was just bracing for infinite upside, it seemed like, almost all year, ever since February and the invasion. And now, you're right, just taking out strikes to the dark side. There probably is more than a few margin calls driving this move this week. You're right, Carl. Hopefully none of the clients over there at DeCarley. Hopefully they're all hanging out hale and hearty over there, Carley. All right, let's keep on rolling out here into all the goodness. By the way, how much paper is going up in nat gas this week? A pretty robust week, 440,000 contracts on the tape. So easy for me to say. Nat gas moving and shaking this week. Again, about 537 kicking off this segment, off about 1.1 points just since Monday's session. So you're talking 16.75% on the week and about 14.4% since the end of our show last week. So they have certainly come for nat gas. Another exhibit of how much this thing is moving this week is it's trading like an equity, 31% of the paper this week. So 31% of that 440,000 contracts is going away in about 6 days. So it's very near dated paper. And again, not surprising. People need gamma. They want gamma in weeks like this when things are whipping all over the place. And so, 31% going away in 6 days out here. If we go a little bit farther out, if we go to the D's contract, that has about 36 days left to go. That did only about 13% of the paper. So interesting how spread out the paper is here this week. We'll look at both just because it's kind of hard to take seriously the vol with 6 days to go. That's about an 84.60, listeners. And then the skew there, the puts were pretty much negligible, about 0.6% cheap last week. This week, 6.5% cheap. So the puts have come in, again, as we've blown through a lot of strikes. That isn't entirely surprising to the downside. The calls, 2.6% bid last week, 4.7% bid. This week's the calls catching a little bit of a bid as we get closer to the expiration. We go a little bit farther out. We go out 36 days. So the D's contract, a little bit different story. The vol out there is about 89.5. It's actually down 5 points from where it was this time last week. The puts last week, 5.1% cheap in the D's contract. This week, 10.9, almost 11% cheap. So the puts are coming in aggressively. The calls last week, 10% bid. This week, 9.4% bid. So that's kind of interesting. The calls have actually come in a little bit. Again, if you move down that aggressively, you might expect that call wing to rotate and those calls to get a little bid like we saw in the November contract. And yet that's not the case. They actually came in a little bit, which is probably indicative of some selling up there to the upside. In terms of the most action out here this week, the most active contract, it was the 6.5 calls going away in about 6 days that did the lion's share of the paper. Nearly 15,000 contracts. So again, as we were starting to threaten that strike, then breaking through it, this contract was lighting it up. The big day was yesterday, about 6,000 contracts on the tape yesterday. Most of that opening, so a lot of opening 6.5 call paper yesterday as we were kind of breaking through that strike. 3,000 going up on Tuesday, 2,200 on Monday, 3,700 today. So still pretty active today as we are now pretty far away from that 6.5 strike as well. And then right behind it, we had the 5 even puts. This one I certainly expected to be up there because we are starting to threaten that strike as well, doing about 14,200 contracts this week. The big day for those, again, today, not surprising, 6,500 going up today as we're getting closer to that strike. Folks are piling into that 5 put strike, about 4,000 going up yesterday, actually slightly closing yesterday. And then about 1,900 each going up on Monday and Tuesday, both slightly opening those days as well. So interesting stuff as we're getting closer to that 5 handle. Not surprising to see folks putting a lot of contracts up on that strike. Moving a little bit farther away, we also have the 6 calls and the 5 half puts. The 5 half puts now in the money puts, both doing a little bit north of 11,000 contracts. Slightly more of the 5 half puts, so we'll start there, 11,200 of those. The big day for those was Monday, 4,200 going up on Monday, slightly closing actually. And then 3,000 yesterday, also closing. And then 2,000 each Tuesday and today, slightly opening on Tuesdays. This one's kind of been back and forth, which is kind of interesting. But again, as we've approached that strike and then broken through, it made sense. Maybe some folks are piling in and then getting the heck out of Dodge. Then 11,000 for the 6 calls. Again, all these are going out in 6 days, listeners. 11,000 of those. The big day for those also today. So today, a very active day for nat gas, obviously. 5,100 today, 4,700 yesterday, most of that opening. 1,000, almost 1,100 on Tuesday, again opening, and then only a couple of hundred on Monday. So kind of a quiet day there. So interesting stuff. Again, we're starting to see strikes popping up on our radar here in nat gas, listeners, that we haven't seen in a while. That said, it's not all 5 and 6 handle options. It's if you go out to Jan, we're still trading some 10 calls. 9,200 of those have traded, including 5,600 today. So a lot of 10 calls going up in Jan out there today. Obviously, we don't know that's opening or closing, but there is some size OI. So there's a chance some folks are getting the heck out of Dodge on the 10 calls in January. They decided this is just too much pain for them. They can't take it anymore. Also saw the 10 calls trading pretty actively out there in February, about 7,400 contracts. Again, the big day today, 3,300. And again, there's about 11,000 contracts open there as well. So it could be some folks getting the heck out of Dodge. We also saw what looks like a 10-15 call spread going up yesterday in February, 2,500 times. So both opening on both legs. So somebody was opening the 10-15 vertical in February. So it's not all bailing out and diving into the downside, listeners. Some folks playing on the 10-15 as well, listeners. We go a little bit farther out. We're seeing strikes we haven't seen in quite a while, like the 2 puts. Once again, that 2 put strip going up pretty much from April all the way out to, I think it goes out to at least September. It used to be the 3 puts. Now they're back down to the 2 puts, kind of a reflection of where we are, listeners, out here. And interesting stuff. Carley, anything else lighting up your tape in nat gas before we roll on into its sister energy product, which is WTI?
Well, you mentioned the activity in the $10 call, and it's just completely astonishing that option for the January expiration is still trading at about $3,500. I mean, it wasn't that long ago. A couple of years ago when nat gas was hovering around $2, $10 strike wasn't even listed. And if it, when it did first get listed, it was probably worth a tick or so. So it's really quite remarkable to see how wild this market has become in the last couple of years. I personally wouldn't be a buyer of that call. I'd probably do some sort of a call spread, but I do like the upside.
Yeah, we were just talking about 10 calls not too long ago, that we broke through it. Everyone was freaking out. And then here we are back to not quite a normal range yet. You got to get more into a 3 handle for that, but still semi-normal, dare I say it, Carley.
Yeah, natural gas is not for everybody. Let's put it that way.
No, definitely not this year. That's for sure. When it's hanging out at 3 and not doing anything for months at a time, okay, then it might be a little bit more for everybody. But this year, nat gas has been quite the banger, as they say. But also is moving and shaking a lot these days, and also has been driving a lot of questions and comments from you folks, is WTI. In fact, we have our friends over there at CME in the CME Research Department. You know, we've had Eric on the show before. We've had Blue on the show before. This one looks like a newcomer to that team, Amanda Townsley over there, talking about her 5 fundamental reasons for high oil volatility over there. Check it out over there at CME Group if you are intrigued. It's under their open markets portal. That's where they put all their research. And she lists her 5 driving factors. Again, it's a pretty in-depth article. I'm just going to summarize it for you here, listeners. Number 1, economic indicators and Fed policy, obviously. Number 2, Chinese COVID policy having a nice impact on WTI. Number 3, the Iran nuclear deal. Number 4, OPEC meetings, obviously, and minister commentary. I would think that might even be higher given what they've been saying out there of late. And then number 5, we have the issues going on with our strategic petroleum reserves out there. We've been kind of emptying it of late. And what does that mean going forward? And so interesting article. Again, check it out. A lot of graphs, a lot of analytics. She writes here, with large uncertainties, it's no wonder that the options market continues to price high volatility. In fact, as of early October 2022, the term structure of WTI is in slight contango with even higher vol prices through mid-2023. The 10-year average of at-the-money volatility is about a 34 in WTI. And the forward curve, she looked out all the way out to 2025. She says it's still pricing in levels above 40% all the way out to 2025. So a lot of vol being priced in the long term out there in WTI. Carley, what are your thoughts on all the action we've seen in crude out there lately?
You know, crude's, there's a war going on, and it's a war between global central banks who are raising interest rates to try to thwart demand for energies and other commodities. And then we have OPEC, who's cutting production to offset the work that the central banks are doing. So very interesting times. I happen to believe that the path of least resistance is lower for crude oil. I think the low 90s is probably a bit of a ceiling, but even if I'm right, it's not going to be a smooth ride either way. I mean, this is going to be a really, really messy market. But as far as a fundamental standpoint, I know U.S. producers have been criticized for being slow to react and slow to bring product onto the market. And I think we can all agree that's probably true. But the reality is they're getting really close to all-time production highs. I think we're within 1 million barrels a day of production that we saw in 2020 before the COVID shutdown. So U.S. producers are slowly coming online. Rigs are being added. So supply is coming to the market. And unless the economy is just, roaring, which I don't think it is, I think it will be hard for crude to hold $90 or higher in the next 6 months. But again, my crystal ball doesn't always work like I expect it to.
Well, we are seeing WTI hanging out right now at the 84.70 level. So kind of unched on the week here, which is actually kind of interesting. You can head on over to our movers and shakers report, listeners, if you want to see where it is since our last show. And of course, there it is. I'm finding it. So it actually is right outside our bottom 5. It would be number 6, listeners, off 3.25% from our show last week. And again, kind of interesting to see how much downside we've seen in WTI post OPEC. Everyone thought that was it. That was kind of the line in the sand. We were going north from there. And then we have seen some mixed action post OPEC. Let's get on out to what we're seeing right now. How much paper on the tape? 470,000 contracts. So WTI, even though the underlying kind of hanging out right now, we're seeing a lot of options paper out there this week. And of that, 35% going up actually in the February contract. Has about 90 days to go. So let's head out there, see what's going on. That future is at about an 82.13, so a couple of bucks below where we're looking right now on that front contract. The vol out there is at about a 48, off 3.5%. Remember that research saying the 10-year average at the money vol is about a 34%. So we're well north of that still out there in WTI, kind of pricing in this tug of war, what we were just talking about, those 5 factors that are contributing to this extreme vol we're seeing out there in crude oil right now, at the very least elevated vol out there in crude oil right now. In terms of skew, we're seeing the puts in this Feb contract last week, 3.8% bid. This week, nice even 5% bid. So folks bidding up some puts in spite of OPEC. The calls are literally unched, 1.1% cheap last week, 1.1% cheap this week. So the calls haven't budged. The puts getting a little bit juicier this week. And of this 470,000 contracts, listeners, the 115 calls doing a whopping 87,000. I hope I don't pull this up and I see it's another one of those ridiculous 1 point wide verticals. And you know what? It is, listeners. Our friends out there, whoever has decided that they like this strategy, CME must love them. Their brokers must love them. They're generating a lot of paper. For the consequence of what, I'm not sure. This 114, 115 vertical went up about 26,000 times on Tuesday, listeners. And then it went up on a ratio today, about 58,000 of the 115s by 28,000 of the 114. So they're doing it on a ratio now, which means 87,000 of the 115s have traded this week and 53,000 of the 114s. Carley, I'm not sure if you and I have chatted about these ridiculous 1 point wide verticals. They have been trading for size for the better part of the last few months. Are any of these going up with DeCarley clients? Why are you guys putting up so much paper, Carley, in 1 point wide verticals in WTI?
I was just going to say, as a broker, why can't I get
Yeah, you would love this. We call these on the network, Carley, love your broker trades.
Just kidding. Yeah, no, I think if you're like, in theory, your risk is limited, you put up a small amount of money and it could pay off huge if you hit, but the odds of something like you might as well buy a lottery ticket. Like, it's just, that's not a high probability trade. Let's put it that way. That's
exactly what it is a lottery ticket. Yeah. I think we looked it up last week or 2 weeks. I think they're paying somewhere around 11 cents. So theoretically, you can get an almost 10-to-1 return, but
but the odds are slim.
Yeah, the fact that there's some fund out there that has hit upon this as its strategy. Yeah. It just,
you know what? Maybe someone accidentally hit, like in March when crude oil went nuts and gapped up $13-14 on a Sunday night open. Maybe someone had one of those on and they think this is like a long-term viable strategy. I don't know, but
someone clearly likes it because it keeps printing, not these exact same strikes, all kinds of different ones. 119, 120, but they're always $1 wide. Like there's 81,000 open of the 120s right now. I wager that's a lot of that is this 1 point vertical stuff. So yeah, it's been trading for a while. Someone or some funds out there have hit on this as this is their go-to in WTI right now. You might as well go down to the corner store and buy the scratch-off tickets in WTI. Because
I agree.
That's kind of what you're doing out here. But alas, and it's also skewing the numbers. It's showing all this paper. It's kind of like the people who sell the 1,000 handle out of the money puts in E-mini every week. It's not real meaningful paper, but it's there and it's gumming up the works out there. So let's dig a little bit past that, listeners. Let's dig past the 115s and 114s that have collectively done, about 130, almost 140,000 contracts between the two of them. Let's go a little bit farther. Let's go out to the pars. The pars in December did 11,000 contracts out there this week. Pretty much about exactly half of that today, about 5,600 going up today. 2,000 each Wednesday and Tuesday, about 1,000 on Monday. Back and forth, opening to closing. And this par strike has been a very important psychological level for a while, obviously, listeners. And looks like a lot of folks may be bailing on that earlier this week. Obviously, we don't have today's OI. There is almost 41,000 contracts open on this strike, so a good chance there could be some folks bailing on this. Let's look really quickly at the skew out here. Maybe that'll give us some insight as well. This is where the calls were pretty much unched. So not a lot of evolution in the call wing in pretty much any of these months. It wasn't a call-driven month outside of that ridiculous vertical, listeners. There's a lot of puts. I'm scrolling here for any other interesting paper. How about the 65 even puts in D's of next year going up 4,700 times, listeners, 2,800 times on Wednesday, most of that opening, and about 2,000 times today. So opening paper on the 65 puts, nearly 5,000 contracts this week, listeners. So if you're not liking the par level, allow me to present perhaps the 65 puts as an alternative. All right, Carley, we hung out in energy long enough. Where should we head next on the movable show that is the TWIFO program?
You want to talk about meats? Those are the big movers.
Oh, we can do that. All right, out to the lean hogs we go, listeners.
It's time to get our hands dirty exploring the latest options, trades, and trends in corn, wheat, soybeans, and more. It's time to talk ags.
All right, everybody. Welcome to the wonderful world of ags. That's, of course, where all this fun stuff is located. The ags complex. A lot of interesting stuff in there. It's not just your corn and your wheat. We're going to go all the way back up to the top of the list, listeners, for agriculture. And then we're going to pass over grains and oil seeds and corn and wheats and soybeans and everything else. We're going to go all the way down 5 slots to livestock. And then we're going to hang out. Let's pull up live cattle really quickly before we get into lean, just to see how much paper. Actually, live cattle's doing 36,000 contracts this week as well. So we could potentially hang out there. Lean hogs, 75,000. So lean hogs are becoming much more of a story. I'm curious for you, Carley, are the livestock, is the meats, as you put it, is this becoming a more interesting area for a lot of your clients over there at DeCarley?
It is. We tend to have quite a few farmers and ranchers. So, people that are involved in the ag industry in general. And so this is actually kind of a popular space for our clients. And there's a few things I'm going to point out that most people, I know it's not like in the world of option trading, the first markets people look at are not hogs and cattle, but maybe they should be considered for a couple of reasons. For one, they don't trade around the clock. Now, some might think that's a disadvantage, but as a broker, I can tell you sometimes around the clock trading, like overnight trading, really can get out of hand and triggers risk issues, margin issues overnight for people that sometimes they can't survive. I hate to say that, but that happens more than you want to believe it happens. So the nice thing about the meats is they trade in a day session only, which is where all the liquidity is. So you don't have like the thinner overnight sessions pushing things around to crazy prices sometimes. Which happens in some of the other markets. So they're a little more, I'm going to say they're a little better behaved in general, usually, not always. Any market's capable of being crazy, but they're a little more behaved. The margins are lower, so they're nice if you're a beginning option trader and you do want to do spreads or those sorts of things. You can do them in these products with low margins. And liquidity is not the greatest, but it's not bad either. If you want to, they're definitely tradable. There's great market makers. You can get in and out as you need to. The only exception to that is the meats do have a tendency to go limit up or limit down a little more than some of the others, just because they are a little thinner. And if there's a big surprise, fundamental surprise, sometimes prices get locked up a little bit. So you have to keep that in mind. But all in all, it's a place everybody should at least consider dabbling with. I think you'd find that it's not as bad as you might think.
A very eloquent argument in favor of the meats. How dare you say no one watches the meats? First thing I do when I wake up in the morning, Carley, I rub the sleep out of my eyes and I fire up my quotes on lean hogs. Am I alone? Am I the only one who does that? That's my first stopping ground in the morning.
No, I think you have good company.
Yeah, you're right. Clearly. 75,000 contracts going up out here in the hogs. This is a relatively interesting and recent development out here. When we first started doing this show, and even the previous incarnation, the long and short of futures options, lean hogs did some paper, but not a ton, and nowhere near the 75,000 contracts it is doing now. So it is definitely becoming much more of an option stalwart. Lean hogs also our number one light side mover this week, listeners, up 7.82%. If you don't follow lean hogs day to day, in spite of that impassioned plea from Carley, they're at about an 86 and good old 7/8. You don't see those around anymore. But seeing that out there in the hogs, up about 4.6 handles or about 5.6% just since Monday session, obviously up nearly 8% since the end of our show last week. And how much paper? Again, 75,000 contracts and 63% of that going up in the D's contract. That still has about 55 days left on it. What is the vol out here in lean hogs, you might be asking? It's at about a 23, off about 2 3/4. So it's not explosive vol, but it's certainly not single digits. It's not rates or FX vol either. It's a little bit of a halfway point maybe between your rates and then your equities, or certainly your WTIs and other even more volatile products out there. In terms of skew, wow, these puts were pretty juicy last week. The D's puts were 26.3% bid, listeners. So you're talking about a 23 vol and a 26% bid on top of that, which is kind of interesting. This week they've come in. They're still pretty juicy, but they're about 10% bid this week. So obviously a lot of the interest and or concern to the dark side out here in lean hogs in December. The calls were kind of unched last week, 2.5% cheap. So there was no interest in the calls. It was all of the puts last week. And this week the calls are almost 7% cheap. So the calls have gotten cheaper and the puts have gotten less bid. The calls have come in a little bit as well. So intriguing stuff. So as that vol comes in, I guess it's taking the wings down with it. But either way, that was an extreme bid for those puts last week. I guess if you wanted to sell puts in the hogs, last week was the week to do it. Wow. In terms of action, like we said, about 75,000 contracts on the tape. The big dog this week, is the 92 calls in December, trading nearly 4,000 times, most of that on Tuesday, 2,400 on Tuesday, slightly opening, so a lot of back and forth on the 92 strike, which is interesting. About 1,100 on Wednesday, about 300 on Monday, and only 64 today. So not a lot going up today. The big days, Tuesday and Wednesday out there. So a lot of opening on the 92 calls. Looks like also action on the 90s, about 3,100, so maybe a little bit of a vertical action, even though none of it lines up. The 90s are trading on completely different days, 1,500 on Monday and about 800 on Tuesday, and a little bit today and a little bit yesterday. So it doesn't really line up, but 90s and 92s in December were both trading. Also, these 76 puts, obviously these are about 10 handle out of the money puts, a little bit more than that now, doing about nearly 4,000 contracts this week, 3,800 to be precise. The big day was Monday, 2,100 going up on Monday, about 1,100 on Tuesday. The rest, such as it is, scattered throughout the week. So opening on Monday, closing on Tuesday and on Wednesday. Not a lot going up today out there. So yeah, it kind of does trade, not quite by appointment, but a little bit staccato out there. Some days are pretty heavy. Other days, not so much. Looks like it might have been a 76, 72 put vertical that went up on Monday, listeners, about 2,000 times. Opening on the 76s and closing on the 72. So maybe they rolled up a little bit. Kind of interesting. Either way, intriguing stuff out there. And since Carley asked for the meats, and because they're doing some paper this week, let's also throw live cattle into the mix. This is not a product we get a chance to really sink our teeth into that much. It is number 4/5. It is tied for Class 3 milk for the number 4, again, /5 spot here on our movers and shakers this week. Where is live cattle hanging out? 151.65, up about 3 7/8 on the week, or about 2.6%. Of course, again, if you go back to last week's show, about 2.5%. And again, about 36,000 contracts on the tape out here as well. So nothing to sneeze at. About almost half, 48% going up in the D's contract. That has 43 days to go out here. So we can hang out there. What is the vol, you might be wondering, in live cattle? It's about a 10-12, off nearly 2 points. So the vol has come in quite a bit out here in live cattle this week as well. Interesting. So a little bit of a vol implosion here in the meats in terms of the most active. Before we get to that, let's get to the skew. Let's see if we have similar skew action that we saw in the lean hogs. And the answer is kind of. Last week, the puts were 13.8% bid. So not the 20+% bid that we saw in the lean hogs, but still a fairly hefty bid. This week, 6.8%. So coming in about 7 points. The calls last week, 1.7% cheap. This week, 3.4% cheap. So calls getting cheaper. Puts also getting a little bit less bid out there. And in terms of action, I said we're at a 151.65. It was the 150 calls leading the dance out here with about 2,300 contracts on the tape. It looks like most of that today, 1,200 today, the rest scattered throughout the week. So they've been closing in small amounts all week until today. They put on 1,200. We also saw 1,300 of the 154s going up, but that was yesterday, and that was opening. So the paper doesn't line up for verticals out here, but 150s and 154s are kind of the two most active contracts out here. Also saw the 150 puts. Again, makes sense, a pretty even psychological level, doing 1,500 contracts. Most of that today, about 1,100 today. The rest kind of scattered throughout the week. So there you go, listeners. A little bit of a pit stop here in the meats. Fascinating stuff as we keep on rolling right on into the equities.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everybody, welcome to the wild world of equities these days. If you want to find these for yourselves, pop on out of the ags, scroll down 3 slots to equity indexes, and we're going to hang out in the U.S. Index E-mini. Our first stop, as usual, the Russell 2000, then we'll see if we have a time for any others, even though, again, E-mini puts, we know what's going on out there. In terms of setting the table from a vol perspective, there's a little bit of vol on the tape, as you might have noticed, even though it's down a little bit from what it was this time last week. Coming into the start of the show, we had RVX, so the VIX of the Russell 2000, at about a 34 2/3, down nearly 2 points from where it was this time last week. VIX back over a 30 handle, about 30.80. It was below it even earlier this morning. We've seen a little bit of whipsaw action out there in the markets again today. That's still down about 1 1/3 points from where it was this time last week. VVIX, so the volatility of vol itself, at about almost an 88. That's still down about 12.5 points from where it was this time last week. So if you're not moving 2+% a day, listeners, it's hard for that vol to maintain itself out there. Vol Q, so the at-the-money vol, the NASDAQ, that's at about 34 3/4. That's down about 1.5, almost 1.6 points from where it was this time last week. That puts that VIX to RVX, so that large cap to small cap vol spread, almost 4 points, about 3 7/8 to use the old vernacular out there. That's a little bit more than half a point, about 0.6 of a point tighter than it was this time last week, which makes sense. RVX obviously moving a wee bit more than VIX this week. And the VIX to vol Q, so the S&P 500 to the NASDAQ vol spread, it's at about exactly a 4, which is, again, about 0.2 of a point tighter than it was this time last week. All right, a lot to unpack. Carley, I'm sure your phones at DeCarley are just ringing off the hook with every one of these whipsaw days. First off, before we even get to this week's action, I'm curious. We just came off the heels last week of an epic, nigh on historic whipsaw in the equity market. So maybe walk us through what was going through your mind and what was going up with your clients that day. And then we're seeing a little bit more of that this week. What's your thoughts on our wild and woolly equity markets this week?
Well, I mean, it's definitely been a rough ride. For those of our clients that are trading options, we did have some short puts under the market, 3,500s, 3,450s that got a little bit nerve-wracking for a minute. But luckily,
it's no fun if you're not sweating a little short premium, right? If you just sail in, no problems. Where's the fun in it?
Yeah, exactly. It's got to be interesting. So it was definitely interesting. But actually, what we're kind of been advising our clients to do here the last couple of days, and I actually was on Bloomberg's Option Insight yesterday talking about it, is with the VIX this high and option premium really on both sides of the market, it's overpriced in my opinion. So what we're advising people to do is just sell strangles, like depending on your aggression and your account size and all that kind of stuff. You could either do the E-minis or the micros, but there's plenty of premium out there. I mean, even if you go to 4,000 calls, 4,100 calls, and then maybe on the put side somewhere in the 3,400 range, you still get a ton of premium, and the market's got 15, 16% room to just move around and shake everybody out, but hopefully it won't impact the option sellers. Of course, the caveat is if we get an even crazier move, you have unlimited risk on either side of the market, and that'll be interesting. But I actually, believe it or not, I actually have an upward bias in the market. I think we've probably put in a low, or if that wasn't a low a few weeks ago, any retest of that would probably be minor, slightly new low before we turn the corner. I think it's just gotten to a point where everybody's underweight in their portfolios. And when I say everybody, I don't truly mean everybody, but most people are underweight in their portfolios. Most active traders are net short. So if everybody has already reacted to all the bearish stories out there, we just kind of run out of sellers, and I think we're getting to that point.
Interesting. Strangles in the S&P. Listeners, what do you folks think of that? Hit us up. Let us know. I'm intrigued by your comments. I know we got more than a few premium sellers out there. Maybe you like a good strangle in the S&P right now. Let's get on out and see what folks are up to in the Russell 2000. Small caps back over 1,700, listeners, 1,710 right now, up about 22 handles or about 1.3% net on the week. In terms of where they were from last week's show, they're up slightly, up about 0.75%. They would be at a number 13 spot on our movers and shakers list if we extended it that far. And in terms of action, a decent active week, close to 15,000 contracts on the tape. So some paper, not the most active week we've seen out there in small caps. And of that, it is an equity. So 26% of it is going out tomorrow. That is the 1830 calls. Seems like that's where all the folks are lighting up out there. Again, that's 120 handles above the market. You folks love your small delta calls and small caps for whatever reason. So we'll check out those really quickly for you listeners and see. Yeah, they've been trading mostly Tuesday and Wednesday, opening slightly on Tuesday, closing on Wednesday. 1800s also traded this week, but again, they don't line up at all. So if they were doing vertical action, they were legging it intraday. So 1830s and 1800s both trading over 400 contracts this week out there. Again, all qualifying as small delta because they go out tomorrow. So intriguing stuff out there. Let's go a little bit farther out to see if we can find some other interesting stuff. Let's go out a whopping 11 days, which is an eternity in small caps, listeners, and an eternity even in this market right now. We're seeing the vol out there, and that contract has about exactly a 30. So still hovering just north of 30, listeners. That's down about 2 points on the week. In terms of skew, last week the puts 4% bid. This week, 6% bid. That's actually fairly cheap for for put skew here in any equity, let alone the Russell 2000. Wow, only 6%. We're used to seeing at least double that. Again, but we're also seeing, obviously, this is in relation to the at the money. And when the at the money is fairly high, it makes sense that the premium would be less. Obviously, if we're down at, let's say, a mid to low 20s, it's easier to have a 12 or 15 or 20% even premium to that out there. So you have to take it with a bit of context out there as well. In terms of the calls, last week, 4.8% cheap. This week, 7.1% cheap. And it was the 1880s this week in this end of month October contract. So going out on Halloween. And they all traded on Monday. It looks like it was a vertical. It was the 1860, 1880 vertical going up about 500 times as well. So about 1,000 contracts and that all opening. So somebody opening the 1860, 1880 vertical. Again, we have about 150 handles to go. So for their sakes, I guess I'm hoping they're sold that, but we shall see. I mean, you think we can hit that listener? That'd be a heck of a pop in small caps. Again, given what we can do with these intraday swings, it isn't outside the realm of possibility that we could get there. It just not the type of paper we have seen in the past out there. And also the 17.5 puts doing some paper out here, trading pretty actively out here in the DECE contract as we keep on going. Let's see. So we've hit on equities really quickly here. We did some ag living out here. We hit on the meats. We hit on all things. We did nat gas. We did energy. Let's see how much time we're kind of coming up against it. I kind of want to get your thoughts on this question as well, Carley. So let's head on out to the futures options feedback next.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/the Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's Mixlr.com.
All right, everybody, welcome to your segment, the Futures Options Feedback segment. We'll start off by paying off our question of the week this week. We have an interesting question of the week going on right now. If you folks are listening on demand, as I know many of you are, you still have time to play along. This question of the week expires tomorrow. Right now, we're asking you a pretty contentious question. It seems like a lot of people are having trouble saying the R word out there right now, aka recession. Usually, when I learned about all things econ back in the day, they defined it as 2 quarters of negative GDP growth. We have certainly seen that. So it would seem like, by the traditional definition, we are in a recession. Yet again, folks are skittish to say the word right now for a variety of reasons. So we thought they'd put the question to our audience. You folks aren't skittish. Ask you a very simple question. Is our economy in a recession right now? Heck yes, heck no, or maybe we need a new definition. No one seems to be able to agree on the previous one, so maybe we need a new one. Carley, I'm curious about your thoughts. What do you think? Are we in a recession, or do we need perhaps a new definition? And then more importantly, what do you think our audience is voting for?
I, too, am old school, and I believe that we are in a recession according to the existing definition. I don't see any reason to change it. Recession isn't necessarily a bad thing. If you look at market performance, we actually generally start to improve as the recession is being called. So markets are forward-looking. So I'd actually prefer that we call it a recession, and then we can move on with our lives, and markets would probably stabilize, to be honest.
All right, let's see what our audience has to say. And 78.6%, Carley, saying, heck yes, we are in a recession. So they buy that old school textbook definition. 14.3% right now saying we need a new definition because clearly this one isn't working. And then heck no, only 7.1%. If you agree, disagree, get in there at options. You should be able to find it somewhere near the top. We put out a lot of content, obviously, throughout the day, listeners. We should be able to find it somewhere there. Not scroll down a little bit. You can make your voice heard in our question of the week. And we have a pretty epic treatise here, a follow-up on an epic treatise from Kelvin Hone. He sent in an epic question earlier Carley. That was too long for TWIFO, quite frankly. We just didn't have time to get to it. So we discussed it in depth on our pro Q&A. We gave Kelvin access to that so he could hear it with our buddy, Mr. Nick, who creates the quick strike reports, runs all the Bantic. So he knows a thing or two about futures options execution, because his question was all about execution. In particular, was an interesting strategy, Carley. He was shorting the E-mini, so the future, and then also shorting puts against it. And he had a variety of different, and it was all 0 day to expiration stuff. So it was very near dated. He had a question about why he was doing it in a paper trading account. And he had a question about why said he was still net long. We kind of thought it was an issue. Sometimes paper trading, let's just say the executions and the reporting isn't the best. And that seems like that was the case. We were right. He did reach out to the Think Money folks, and they said, yeah, they had an issue with how they were handling the futures in the paper. So hopefully they have fixed that. But now he writes in to follow up and says, your responses have doubly reassured me this is a Thinkorswim paper platform issue. I did reach out to them, and they have kind of confirmed it, I guess. Not willingly, but they have. I also mentioned when we were discussing his question, I said, how did you hit on this very near-dated strategy of selling the futures and then also the options against it? And he wrote in to say, one of the reasons I do this has to do with this increased volatility. The other reason has to do with how I am day trading futures. I am learning to day trade the micro E-mini futures as well. So he's doing the regular E-mini and the micro using order flow and specifically footprint charts. He says, I have come to notice that these footprint charts have given me levels or zones that ultimately act as intraday support and resistance. I use these as strikes for where I would sell my calls or puts. So he's doing both calls and puts with 0 days. So it's same day calls and puts. I keep a journal of my trades and the zones. He even attached a bunch of images for us. So thank you for the detail there, Kelvin. He gives us an example really quickly. So the call and the E-mini 0 days expiration, obviously 37.30 after he saw it cross below the view op for that day. And so it's an interesting strategy. And then he ends up, if it retraces, he sells puts against the call that he's short. So it's an intriguing strategy. We've seen a lot of people playing very close to the fire these days, 0 days to expiration, which was kind of interesting. It's one of the reasons why I wanted to discuss this with you on the show, Carley. It seems like this is a very trendy thing these days. Maybe not this exact strategy of using the futures and then selling the options against it, but more coming in and playing in, whether it's butterflies or whatever it is, in 0 day to expiration type strategy. So first off, are you seeing that a lot at DeCarley? A lot of people coming in and playing very close to the fire, expiration day. And then B, if you have any thoughts on his using of footprint charts to day trade the micro E-mini futures and the options, have at it.
Okay, so I do like the idea of selling futures and selling puts against it, or buying futures and selling calls against it. Basically cover call strategies, because it kind of cushions your trade. You bring in some premium, and if nothing happens, you get to, the time value erosion works in your favor. And if something goes the wrong way, then that premium you collected is cushioning the losses on your futures. So I like that idea. I'm not sure I love the idea of doing it on the day of expiration. But to be honest, I guess we don't really have any clients doing it that way. Most of our clients, we're encouraging them to use options that expire in 3 days or so, roughly. I mean, sometimes it's a little longer, sometimes it's 2 days, but that way they have a little more premium to work with. But so I don't have experience on doing it the day of expiration. All I can say is in today's high volatility environment, those sorts of things are possible. But if you would have tried to do that in 2019, it absolutely would not have worked, because even though we didn't have options that listed with expirations as often as we do now, I don't believe in 2019, the volatility was so low that an option that expired today would only be worth couple points. It's hard to believe that. That's like what it was. So things have changed, and eventually volatility will go down. It's not going to be like this forever. I'm surprised it's lasted as long as it has, to be quite honest. But that said, volatility has always been temporary, and it will be again. So that type of strategy will have to at some point adjust to longer dated options. But I generally like the idea. I don't really have a comment about using footprints. I mean, it's been my experience that traders just need to find what they're comfortable with and what works for them and what their personality allows. If they trust a certain method, then go for it. That's really the most important thing. Most indicators or tools will kind of give you the same information, just packaged differently. And so in the long run, there probably isn't a huge advantage of one over the other. It's just what if you're a little better at reading a certain chart, then go for it. I mean, it's really that simple. Unfortunately, there's no magic formula that everybody can apply and everybody's going to be successful. It's not really how it works.
Well said, and great question or series of questions here, Kelvin. Glad you had a chance to check out the Pro Q&A where we had a more in-depth discussion of your execution. Glad you're still doing this in the paper money. This is, like I said, a very close to the fire type strategy. It is far more viable, as Carley pointed out now, than it used to be, not just for vol reasons, but the fact that we have an expiration popping off pretty much every day. So it's something you could do almost every day, where in the past, as she alluded, you had to kind of just do it on certain days of the week or certain expiration days. But again, there's not a lot of room for error on, the 0 day to expiration strategy. So it sounds like that you're doing the right thing. And if it's working out for you, I'd be curious to know what the results are when or if you actually take it live. But I'm glad to see you're doing your due diligence first, doing the homework, doing the paper trade before you actually take a strategy like this. Just be prepared. There'll be some crazy whipsaws, as we've seen. Look at a day like last Thursday. Hopefully you were paper trading during that. And if you can survive with this strategy in a day like that, then maybe you got something there. All right, unfortunately, that music means we've come to the end of another excellent, fun, far-reaching episode of TWIFO. Man, we did a lot of living on the show again this week. See, Carley, whenever you come on the show, you always take us to interesting extremes. But before we go, if folks want to reach out to you at DeCarley, maybe they have thoughts about 0 day to expiration trading, or maybe they want to get in on the meats, as you said out there. Maybe they're taking your advice. They want to learn more about the meats. Where should they go? What should they do, Carley?
Well, you can follow us on Twitter. It's at Carley Garner. We put a lot of information out there, but if you'd like to see what we do, how we do it, and see some educational material, visit DeCarleyTrading.com. It's DeCarley trading.com.
There you go. Check them out. She also has 1 or 2 books you may be interested in, including Trading Commodity Options with Creativity, Higher Probability Commodity Trading, and a Trader's First Book on commodities. A lot of you folks ask about where you should start learning about commodities. There you go. It says it right in the title, Trader's First Book on commodities. Of course, give her a follow on Twitter. If you follow us, you'll see her stuff. We retweeted it out during the show. And of course, you know where to go to find these reports and a whole bunch more. That research we talked about with WTI, we just skimmed the surface of it. There's a lot more over there. CMEgroup.com is the place to go for all that. /TWIFO, TWIFO, for our reports. And then for the research, it's on the open markets. And it's just, once you start clicking, you'll be there for a while. So prepare yourself. FedWatch, everything else. CMEgroup.com is the place to go. And of course, you know where to go to find out more about all things small caps. FTSERussell.com, FTSERussell.com is the place to go. Small cap vol correlation. What's going on with small caps? Why are they moving the way they are in comparison to large caps? What's happening with the COVID impact? Is it still a thing? What's going on with the skew? All these crazy questions and a whole bunch more. FTSERussell.com is the place to go for the answers. Of course, give them a follow on Twitter while you're at it as well, at FTSE Russell, FTSE Russell, all one word. That's going to do it for us today here on the network. If you're on the pro side, you want to do a little bit more options living, then I will be doing a session with the folks at the Harvard Business School later today talking about options. You can see the sign-up link over there on the Twitter. We retweeted it for you. Of course, for our pro folks, keep your money in your wallet. We'll put it on to the pro feed later on, give you guys a little bit of access. Just one more bonus for all of our pro folks out there if you want to check out that session. If you want to see what's going on with all things pro, theoptionsinsider.com/pro. Back again tomorrow, of course, noon Central, 1 p.m. Eastern, to talk about all things vol on volatility views. And after that, it's been a wild week. What kind of wild trades? Spoiler alert, we got some to talk about for you pro folks over there on Options Oddities. And then back again next week, all the way through to Thursday, another episode of This Week in Futures Options. Stay safe out there, everybody.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, Visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.